Well, hello and a very warm welcome to Scope Ratings European Banking Outlook 2026 webinar. My name is Keith Mullin and it's my pleasure to be your moderator for today. Apologies for our slight late start. We had some connectivity issues, let's just say, in Milan, but here we are and hopefully things will progress to plan from now on. So I'm delighted to have two analysts on the call today from Scope's Financial Institutions team. So let me introduce you, without further ado, to Michael Troiano, head of the team, and Alessandro Boratti. Thanks, gentlemen. Thanks for, I know you've had a few stressful moments there with getting onto the call, so appreciate your efforts there. Now, in a moment, Michael and Alessandro will take you through a presentation covering their perspectives on how European banks might perform in 2026 and the key risks to watch out for. Now, we subtitled the webinar, Late Cycle Headwinds Put Resilience to the Test, which may offer some indications. Now, after the presentation, we'll be very happy to take your questions, so please type these in as we go along, and we'll get to them later. Please note, as a credit rating agency, we may be constrained in being too specific on single name questions, depending on the question. So I mentioned that as a proviso. Now, we will be publishing a full Outlook report at some point very soon. But as a special offer to you for your efforts in registering and dialing in, we are going to give you exclusive early download of the report at the end of this session, which, let me tell you, as well as today's presentation slides, contains country banking snapshots for France, Germany, Italy, Spain, and the UK across key performance metrics. So it's well worth hanging on to the end to grab that download. So that's it from me. Marco, Alessandro, as I say, great to see you. Marco, I think you are going to start, so let me hand over to you.
Thank you, Keith, and thank you, everyone. Yes, we've had a few connectivity issues, but I think we should be good to go. We'll be just passing on the station between me and Alessandro. I will start by perhaps giving a short introduction on our positioning with the ratings and the outlooks and laying out at a very high level what the main risks are for the sector. I'll hand over to Alessandro, who's going to drive us through our base case and detailed forecasts for the sample of banks that we analyze, and then take it back to go a little bit into more detail on some of the key themes that we see, upside, downside risks, and then maybe take a few questions from the audience. So before we start, just a quick overview of our coverage. We rate around 150 financial institutions in Europe between public, private, and subscription ratings. Around a third of that is public ratings, and you see here on the slide some of our public ratings. Notable additions in 2025 include ING, that we've published a couple of weeks ago, and Alpha Bank, that we've published earlier in the year. In terms of where we stand with our ratings, you'll notice that the vast majority, I would say, of our ratings are in the investment grade range, and that reflects the skew in our coverage towards larger European names. Outlooks are largely stable. We do have slightly less than 10% of our financial institutions' outlooks on positive. And actually, that reflects what we've seen in 2025 and what we expect for next year. We started the year, to be frank, with a cautiously balanced outlook, maybe a little bit skewed to the downside, but the banking sector actually performed quite well, better than we had expected, and that has sort of led us to adjust some of the ratings and also our forecasts for the coming couple of years. Specifically, we were positively surprised by the trajectory of net interest income, which held up quite well, also supported by loan growth, but also asset quality, which didn't deteriorate as much as we had expected. Looking at individual names and individual countries, we saw very strong performance in Southern Europe, effectively leading to some convergence in operating environment assessments, and we will go into a little bit more detail on the next slide. And then we've also seen some rating actions which have been driven by more idiosyncratic situations, such as M&A transactions, whereby weaker banks have been absorbed into larger groups. Or, for example, recently, Deutsche Bank, which we upgraded to A stable, as we believe that essentially the bank has successfully restructured and refocused its business model to reduce the reliance on more volatile investment banking revenues. I mentioned operating environment assessment, so I'm going to give you a little bit more detail on that. Generally speaking, we do see some upwards pressure from this part of our rating construction. Just as a reminder, operating environment assessments are a key component, together with business model assessment, of our rating methodology. Things are going well, particularly in the euro area periphery. There is a continuation of the cleanup of legacy NPLs. And overall profitability is quite strong, driven by the higher interest rates. This is putting a little bit of pressure on this area of assessment that we have. And that has driven, for example, to an upgrade in the country level operating environment assessment for Portugal this year. The other thing I would highlight here is that with respect to Europe and the banking union, we continue to see this convergence in operating environment assessment. So on a scale of 1 to 10, which is what we use to assess operating environment assessments, banking union countries are essentially ranging from 6 to 9, so from moderately supportive low to very supportive low, with the tails really being contained to Greece, Finland, and the Netherlands. Otherwise, majority of the countries would be in the supportive range. Why do we have this convergence? I think that's partly by design. We place a lot of weight on structural elements and institutional elements, for example, the banking union. So this really drives a little bit this convergence. Moving on to what we expect for 2026, and actually, starting from the base case. So banks are relatively healthy. So they enter 2026 in good shape. Yes, profitability is probably going to normalize. It's already normalizing. It's going to continue to normalize. But our expectation at this stage is that it will stabilize at just above 10% for the sample of banks we look at. So that's probably lower than some equity investors would like, but it's a significant gap to where the sector profitability has been in the decade post great global financial crisis and pre-COVID. The asset quality is just fine. We've had pockets of deterioration over the last couple of years, but overall NPL ratios have continued to drift down and have converged. And Alessandro will go into a little bit more detail in that on that topic. And perhaps the other point, which might be at least for some a bit more controversial, is that I actually think that some of the uncertainty on capital is dissipating, in the sense that we now have initial disclosures on the application of Basel III in Europe. We know that the impact from the output floor is nil for this year and seems quite manageable even over the longer term. So that's a question mark that is pretty much gone. We're seeing better disclosure on that from the bank, and what we can discuss there, it's an ever-evolving framework when it comes to capital requirement, and the latest announcement is from today from the ECB. But overall, I think that there is quite a bit of visibility into capital levels, which, combined with the fact that banks are profitable, also gives us some comfort that there is significant buffer, from a credit perspective, if things were to deteriorate. So, talking about, what can go wrong, of course, Keith mentioned we've titled this outlook as around late cycle headwinds. We do think we are in the late and final part of an unusually long cycle, an unusually benign cycle when it comes to credit. So we need to ask ourselves what happens if you have a deep recession, if you have a correction in asset prices, and this, of course, can affect banks. The other source of risk is political and geopolitical risk. Both, political instability in some European countries. We've seen France earlier this year, but also more generally the impact of changing geopolitical landscape on the sector. And this is something we're going to discuss also later on. And also linked to that, what happens to the regulatory framework? There seems to be some push for deregulation on the other side of the ocean, and that, of course, is a big risk from our perspective, because strong regulation is a key factor supporting our ratings. It's probably worth mentioning that there is also some upside potential. A lot of that is actually the other side of the coin of the downside risks, but we have a lot of noise about the potential downside. We could also see, for example, on geopolitical risk, there are scenarios where the current level of noise sort of declines a little bit, and we get a stabilization, maybe a move to a different but still credible world order, which essentially dilutes the uncertainty that is connected to it. So I will stop here for my introduction. I'll come back to speak about upside and downside risks later on, but I want to leave the floor to Alessandro. So, Alessandro, over to you.
Good afternoon, everyone, and apologies again also from my side for these technicalities issues. So I'm gonna present to you the results of our forecast on the top 40 largest rated banks in our coverage. We start from profitability. Net interest margins that have started to decline over the past quarters on the back of lower policy rates. The good thing is that the decline is quite contained. So we see banks that have positioned themselves to counter the effects of lower policy rates with hedges, with lending and funding structures that absorbs part of the impact. And looking at our coverage, we see actually some convergence in margins. So there's some decline in the Euro periphery, whereas for banks in Germany, particularly France as well, actually the margins are increasing on the back of falling deposit remuneration, which declines at a higher rate than the asset side. Now, the positive message here is that we expect the fall in margins to slow down and to stabilize at the higher. The margins will stabilize at a higher level than compared to the monetary cycle. Before this monetary cycle, we expect margins to be higher, and this will be a key tailwind for banks' profitability. Our forecast that you can see on the chart on the right actually still sees some decline in the net interest margins. The median, although this captures some degree of conservativeness still in our forecasts. Looking at loan growth, looking at our coverage, we see loan growth at the highest level in 2 years as of September. There are some outliers, Portugal and Greece being particularly strong, whereas France, Austria, and to some extent Italy a bit weaker. This has been more of a normalization of growth in lending, coming from a period of actually uniquely weak, or rather, I would call it credit sort of crunch following the pandemic and following the rise in borrowing costs. Now things have normalized, and we see growth at a 3% on average across our coverage in 2026 and 2027. So we expect this momentum to continue. And this will support profitability, the net interest income, revenues, and then, of course, profitability. Now, looking at fee and commission income, we have borrowed from the ECB this chart that breaks down for the euro area the key components of net fee and commission income growth over the past 4 years. You see that those segments that we have singled out as particularly pivotal for banks nowadays, so asset management, payments, and all the wholesale banking related services like treasury services, advisor, etc., have pushed fee and commission over the past years. We see actually this trend to continue. Yes, there has been some slowdown in the growth in Q1 and Q2, but we remain actually quite constructive on this forecast. We expect a 5% CAGR in 2026 and 2027, and this is also going to be supported by banks' extraordinary operations, M&A deals. We have seen actually these already in Italy, in France, in Norway, and we expect more deals to come to support banks' net fees and commission income. So all in all, we have upgraded our forecast for revenue growth. We expected just 1 year ago more flattish trend going forward. Instead, now we see a more benign environment with a growth between 3 to 4% in the coming 2 years. Now, moving on and discuss costs. So costs remain a key at the heart of bank strategies. The cost discipline has been pushed for many years. Now, you need to consider, if you look at the chart on the left, where you see that the level of operating efficiency has remained pretty much stable with a couple of outliers, but the costs have undergone a significant spike in inflation between 2023 and 2024. You see actually in the chart in the center, and we expect now this pressure on costs to soften. We see something that actually we have discussed in July. We see moderation in wage growth, and there is of course also the decline in the contribution to the deposit guarantee schemes, to the resolution funds. So all in all, we see some softening on the pressure on costs, which, as you can see in the chart in the center, should decline to around 2% by 2027. So all in all, let's say the outcome on what I've just told you is that cost to income is going to slightly increase in 2026 to then stabilize, but at a much lower level than compared to the pre-pandemic. And this is a structural improvement in profitability at European level, and something that we actually that we build on for going forward, and that is provides a good basis for against downside risks going forward. Now, cost of risks. We have reverted to our December 2024 forecasts. We were a bit more conservative, a bit more cautious in July following the announcement of the US tariffs and the volatility in global trade. Now, 9 months results in, and we see that the cost of risk is at its lowest level, or at decade low. And this reflects the fact that banks have carried out the exercise of going through or try to stress the position and their positions, and there seems to be quite of a sort of resilience in the loan book, and we think that this level can be maintained, of cost of risk can be maintained over the next couple of years. We see some deterioration particularly towards 2027, which more than anything reflects some deterioration of or rather an increase in default risk in the corporate segment, but I'm going to touch upon that in a minute. The chart on the left summarizes what is our view for 2026 pre-provision profitability, which summarizes the bank's ability from a P&L point of view to absorb provisions, and you see that the buffer is ample across our coverage, with the exceptions of three cases. The slide you now see is the outcome of our forecast. We have again upgraded the projections for ROE for 2025, but also, and more importantly, for 2026 and 2027. We see the ROE being comfortably above 10%. We see still in 2025 a dip in the net income, but then a stabilization in 2026 and 2027. There is a bit of equity effect, so the denominator effect that is dragging down the ratio, but overall it's a very I think it's a very constructive and a very strong results or forecast rather for banks going forward. A couple of words on asset quality and capital, and then I'll pass it on again to Marco. I've briefly mentioned the fact that the cost of risk should remain well under control for banks over the next years, and we partly rely on our discussions with banks, and the discussion with banks is that, I mean, the key message is that there is no deterioration, and we have for this occasion we have updated the chart coming from the EBA that shows how many banks in percentage expect a deterioration in each of the main segments, loan segments for the next years. And you can see, despite the uncertainty, despite the geopolitics and the worsening of the global trade environment, you see how the forecasts have improved over the past years, particularly in commercial real estate, where there is more visibility on prices. Property prices have started to improve, particularly where the issues were in Germany and Austria, and this is important, of course, for loan performance. Overall, also low expectation of deterioration in residential mortgages and in large corporates, whereas a bit higher for small companies and consumer credit. But overall, banks remain quite optimistic about the coming quarters, and we reflect this in our forecast for cost of risk and also in asset quality. We expect further convergence in our coverage and among the top European countries. We still see some worsening in Germany, with instead improvements in Europe periphery, although now you see Italy has finally reached the EU average. We see further improvements in Greece, and so all in all, the stage 3 ratio will remain broadly stable at around 2.2% over the coming 2 years. A couple of words on capital as well. Now, on the July outlook, we discussed about an initial dip in the buffer on the capital requirements for European banks. Now this has been recovered in the following 2 quarters, reflecting the stronger profitability, which has replenished the capital shortfall from the introduction of the CRR3 rules. Now, a trend that we are starting to see, though, is that banks are proactively working to reduce their risk weights through a numbers of initiatives. For instance, the use of significant risk transfer, through lending towards lower risk segments or investing in sovereign bonds. Now, this of course supports capital ratios, but at the same time, let's say the effect it has is that the leverage requirement becomes more binding, and we don't think it's a coincidence that in Q3 the largest number of banks over the past 5 years in our coverage reported a more binding leverage buffer to leverage compared to the buffer on capital. So it's something that is not a worrying sign, let's say, something that can happen, but it will warrant more attention from ourselves, analysts, on leverage going forward. I've briefly touched upon the SRT topic, a very hot topic at the moment, and Europe is at the epicenter of issuance of significant risk transfers, and in particular synthetic SRTs. Also in 2025, we think that the practice is well established. It is a practice endorsed by supervisors. Of course, if you look at the chart on the right, we see that there are a few cases of a combination of low buffer to capital requirements and big usage of SRTs. So there could be situations where there is rollover risks in a crisis, perhaps, and this could create some problems for some banks. I remind you that 75% of SRTs are in the hand of 10 large investors, and so this creates some risks for banks. And that concludes my part. I'll give it back to Marco, and yeah.
Thank you, Alessandro, for the presentation. I'll try to be quick, Keith, so we leave enough space for Q&A. I'll go through the main upside and downside risks that we see for our ratings and for the sector. So starting off with macro risk, you have a couple of charts here which depict our base case. As you can see, we see some acceleration of growth over the next couple of years. This is mostly driven by Germany coming out of its recession and having a growth profile normalizing. At the same time, 4 out of 5 of the large countries in Europe are going to grow at 1% or less. That's not exactly a lot of buffer, so a lot of things can go wrong. There is very limited room for policy mistakes or very little room to absorb shocks if they come. So that's a clear downside risk for us on the growth side. Of course, things can also turn out better than expected, and that would be, of course, positive for the ratings. On the right-hand side, you see the expected path of interest rates in major economies. So if we focus on the euro area, we're essentially expecting stable interest rate for the next couple of years. We have 1 rate cut in 2 years, so policy rates dropping at 1.75. Now, a lot hinges on this when it comes to net interest margins. So if we were to face a much looser monetary policy, that would probably have implications for bank revenues, and specifically for net interest margins that we will need to incorporate. Just staying with macro risks, we highlight the risk of sudden asset price corrections. We've put a few charts here showing the good run that several asset classes have had. Equities, gold, Bitcoin, they all have in common the fact that they're real assets, so they're partially supported by the so-called debasement trade or essentially inflation hedges. It's also true for residential real estate, which have continued to go up in recent years. And this is, of course, important for a number of reasons. First of all, I mean, it's not for me to call whether we're in a bubble or in a tech bubble or not. But what we know is that this is collateral for bank lending. Whether it's real estate, whether it's equities, gold in some cases, Bitcoin, hopefully not too much, but it's also starting. So there are implications for asset quality, expected credit losses if asset prices come down. Perhaps more important is the confidence effect that some of these corrections might have. So again, we don't think that markets can correct and banks remain completely immune. I mentioned political risk in my introduction. Again, here on the left-hand side chart, on the left-hand side, you see this chart of sovereign spreads. Quite interestingly, France, the French spread has now crossed over most of the peripherals. But you can also probably appreciate that this is not really driven by a deterioration in the French spread. It's mostly, the further compression of spread for Italy, Portugal, Spain, and Greece over the course of the last couple of years. What I mean by that is that there is a lot of downside risk. If anything goes wrong and you have a rekindling of political risk in places like Italy, for example, where we now are living an exceptional moment of political stability, that could actually bring some volatility to markets and a second order impact to the banks through their funding costs and through the confidence channel. Now, there isn't an obvious trigger for political volatility in 2026 other than the midterm elections in the United States, which, if you ask me at this point, look more like an upside risk for Europe than anything else. I don't know how much worse than this it can get in the transatlantic relationship. But when we look at Europe, there are quite a few important electoral appointments in 2027. And we know from experience that as big electoral moments become closer, coalition governments become weaker. They start to argue, and that can lead potentially to some volatility. And even if it doesn't happen, I would actually expect the market to focus more and more on this type of risk as we move through 2026. Moving on to geopolitical risk, I mentioned what I think of the midterm elections. If you asked me a couple of years ago about geopolitical risks and banks, I would probably have given you an answer around Russia, Ukraine, or Middle East and exposure to conflict areas. More and more, I think the US is emerging as the key source of that risk. We've seen 2025 was the year of US trade policy. We don't know what's going to happen in 2026, but it seems very clear that the current US administration looks at the EU as an inconvenient rather than anything else. So we need to ask whether other policies could turn into downside risks for Europe. Particularly, I'm looking at US dollar policy as a potential source of risk. There is, an established financial order that is built around the dollar, and it's built around certain assumptions of dollar availability, including in a crisis. European banks have funding in dollars, and generally they have funding shortfall in dollars. So keeping a close eye at what happens with the US dollar and with the Fed, I think would be paramount over the course of 2026. And I'm pretty sure we're going to have more time to discuss these topics. The other big one is the regulatory debate. We've had an announcement today from the ECB high-level task force on simplification. For the time being, it seems that Europe is content with moving towards simpler frameworks, but not necessarily to deregulate the sector. I'm very happy about that. If you've been following our research over the years, you're probably very familiar with my analogy of the pendulum when it comes to regulations. I see regulations as just a pendulum that swings following political forces, and right now it really looks like the pendulum has lost momentum, it's sold, and is swinging back towards deregulation, at least in the US. And the big question is what happens next? Will Europe follow? There's a question mark around the level playing field. So I was actually quite pleased to see the announcement today that there isn't, any significant drive towards making the sector less stable or less safe. But let's see how that evolves. It's very, very early days, and there's going to be a legislative process over the coming years. And this is probably not necessarily a risk just for 2026, but it's more direction of travel. but it's a very important topic for us. Our ratings benefit from the regulatory stability in Europe that has been built in the post-GFC world. So rolling that back will not be welcome from our perspective. And then, one last slide on M&A. I think this is still a theme. It's been with us for a couple of years. I do think that the M&A cycle is still alive and kicking. In 2025, in my view, there have been primarily two interesting developments. The first one is the role that governments have taken in the whole saga. So we've seen government being quite vocal in Spain and Italy when it came to the sector consolidation, and we see the German government also very involved in the UniCredit Commerzbank stake building. To me, that's not welcome. That's sort of discouraging private investment in the sector. But at the same time, it's sort of underpins one of the theses that we've been pushing around for some time, that European banks have almost become semi-public utilities, where you have a lot of support in crisis times, and you have a lot of public meddling in good times. And we've seen it with the bank levies, we've seen it with the different extraordinary taxes, and we've seen it more recently with the M&A cycle. So that's not necessarily a very bad thing for credit if you look at it, in its entirety. The second interesting development is that while in the past we've had a lot of announcement around domestic consolidation deals, 2025 has seen a few deals which were actually cross-border in nature. For example, the entrance of a large French bank in Portugal, or the acquisition of Erste Bank in Poland. Why do I think this is actually significant is that our view is that cross-border consolidation doesn't create a lot of value at this stage, because you can't really unlock all of the cross-border funding synergies that you're supposed to achieve when doing a cross-border deal. So it does have some positive implication for business models and for diversification, but from a financial perspective, it's a more difficult sell. And the fact that banks are still going for it is actually encouraging. It means that there is some momentum, and this could turn into increased political pressure for legislators to essentially take the final steps towards the completion of the banking union and unlock these synergies. So I will stop here. I'm sorry I've been a bit longer than I wanted to. Keith, we can move, I guess, to Q&A. Given the funny setup, I would say I will give a first stab at any question that comes, and Alessandro can read them in the chat. So if he has anything to add, he can just tap me on the shoulder and jump in.
Yeah, makes sense. So first, before we get to Q&A, thanks for those comments. Very interesting insights there. Look, guys, there's a lot of questions that have come in. We'll try and get through them efficient as possible. There's a lot on capital. There's a lot on simplification, and so I'm going to try and kind of merge them into an answerable question, Markov. So look at so this simplification process. It's obviously moving ahead. Governing councils now endorsed the high-level task force recommendations. One of our questioners has noted that there's a lot of lip service around this. I guess the implication being, let's see actually what happens, which you pointed out as well. But look, first of all, just reiterate: is simplification a positive force? Is there a risk that we drift into deregulation? And I guess just the third part of this is, shouldn't the European Union be actually thinking about deregulating to maintain this global regulatory level playing field? So first, is simplification a good thing? Risk of deregulation, and actually benefits of deregulation from the perspective of a global global level playing field?
Look, it's a very complex debate, right? So my view is simplification is positive. We do have a very complex framework, which has been built over essentially a decade or more. And in some areas, it looks redundant and ineffective. So I do think that there is room to make the system better. I don't think that regulation should be written in stone. I do think that regulation has to be dynamic. So we need to keep an open mind, and regulators should keep an open mind. If there are, obvious overlaps, or if there are things that are not working, they should be looked at. Now, at the same time, and there is a risk that this ends up making the system less safe if it's not done properly. Now, to the last part of your questions, whether regulators should look to deregulate the sector to maintain the level playing field, I have a very strong view. We shouldn't. Of course, there is a trade-off between supporting growth in the short term and lending growth and keeping the system as safe as possible. My view is that it's not clear to me that Europe needs more credit. It's an old continent with bad demographics, with already very high level of debt. So are we sure we want to have more leverage in the system? I'm not sure. I think it could support in the short term. It could support volumes. It could support defense investment. It could support green transition or technology transition. But I'm not 100% sure that's the right form. I think we should be focusing more on the savings and investment union and make sure that that capital comes in the form of equity and risk capital that can sustain it in the long run. Because if we don't, it's going to come at the expense of safety. So we're going to be trading off short-term growth for long-term safety. And I think, more than happy. I mean, I was a bank analyst in 2020. In 2008, I remember the sleepless nights. To be honest, I've never had a bad night of sleep because of too much capital in the banking system. Since I'm on the rating side.
Okay. There's one angle to this. The US is not implementing final Basel III. So if they end up with lower capital requirements, in effect, doesn't that offer US banks a free lunch in Europe? That's rephrasing the question, I guess. But
yes, again, it's a topic of short term versus long term. If you have a more restrictive capital framework, you will have to be more selective on the type of business that you do. So you're going to stick to the safer areas of the market, which might mean lower growth in the short term, but then in the long term, that means not having the next financial crisis. And to be honest, I think the right way of posing the question is not in relationship to the U.S. banks, but it's in the relationship of the non-bank sector. It's a legitimate debate, where if you over-regulate, you're going to push some of the risk outside of the regulated perimeter, and you're not really going to get rid of it. But at the same time, if that happens, it's not going to be your essentially my grandma's deposits at stake, and that's going to be a lot less need when the next big one hits to go in again and try to bail out the sector. Yeah. So I do think we can live, with having an unlevel playing field for a period of time and maintain a strong sector, at least in Europe.
Okay, then Marco, what's your take if we end up with, like the Australians have done, kicking AT1s into touch and replacing it with perhaps more stable forms of capital, but loss absorbing capital? I mean, what's your general take on that at perhaps a high level, if you want?
Look, I've changed my mind recently on this topic. I mean, for a long period of time, I was actually quite a fan of this idea of going concern additional capital. But the reality, it hasn't worked. I look back at the past 10, 15 years, I mean, since the asset class is around, basically, it hasn't really worked as a going concern form of capital. So I think it's a legitimate question. I haven't had time to look into the details of the ECB high-level task force recommendation today, but there was a very interesting paper a couple of weeks ago coming out of the BIS from Borio Restoy and a few other chaps. And I think one of the proposals was to actually kick AT1s into touch and replace them with pure equity CT1.
Yeah.
I have some sympathy with the proposal. I'm sure the investment bankers and rating agencies on the commercial side will not have a lot of sympathy for that proposal. But I can see that it's not serving the purpose it was designed to. So either it needs to change and be maybe revised, or why not? I think it's an area where work can be done.
Okay, you mentioned private credit. Now, there's a few questions that have come in around private credit. So again, these are topics that are in their own right could take us for a whole session. But banks are very heavily engaged with the private credit universe, both in terms of their exposure to private credit lenders, to fund investors, to end borrowers. And as we've seen through various disclosures and regulatory concerns, it's not always easy to track, and it's not always easy for banks to actually know where the exposures are. Can you just perhaps summarize in a few paragraphs where that ranks, where private credit ranks in your list of concerns, and what specific concerns you might be harboring?
I mean, it's there. In fact, when we started to work for this outlook, it was on the list of what we wanted to include. But then it doesn't really made it to the top 5, right? So we haven't included it. The reason is that overall, I still don't think the size. I mean, it is relevant, but in the context of the overall European banking industry, is not that big. The concern comes, and I understand exactly why supervisors are worried about this, is that it's very difficult to track and put exact numbers on this issue because of the different layers of leverage. For me, the concern is that there is at least anecdotal evidence that there is a degree of round tripping of risk between the banking industry and the private credit funds. And the second one is that probably banks themselves don't have, at least I was reading a regulatory paper recently that highlighted how banks themselves can't really measure the overall exposure to the final borrowers. So that there's probably an area where risk management has to improve. But again, I think this is one of the examples where you see the value of having a strong regulatory and supervisory architecture. This is an area where the supervisor can go in and tell the banks, up your game on risk measurement and management on this particular topic. And until you do, I might decide to slap, an additional requirement on you if I'm not satisfied with what you're doing. So I think that highlights, the importance of having a pillar 2 and a SREP process, which not every jurisdiction has, and to actually maintain that high level of scrutiny on what banks are doing.
Yeah. Okay, Michael, there's another very major topic here which I want to throw at you, which one of our delegates has kindly written in, which is, I guess, to do with this whole process of digitalization. And the question really focuses on how do you see the resilience of major EU banks to major non-financial risks, and there's cyber risk, geopolitical, and things like US cloud concentration risk, etc. There's a whole bunch of things that are out there around this topic. From what you've seen, to the extent that banks kind of disclose such topics, are you comfortable with the resilience and the risk assessment and risk modeling, risk management that banks have to these non-financial risks?
I mean, it's a very broad question. Huh?
Really?
So let maybe just trying to break it down a little bit. Digital, I think banks have been living with this risk for best part of the past couple of decades. There is a history, there is a way of measuring and managing transition risks, from one system to another, and you do have cases of operational disruptions, but they haven't really turned into credit problems for the bank, so they tend to be quite contained. Then I think you mentioned cyber, and there is evidence that cyber accidents or even attacks or hybrid warfare is actually increasing in Europe. That's probably partly driven by the geopolitical landscape. but we haven't really had, major consequences for the financial sector when you compare it, for example, with, I don't know, hospitals, public sector, utilities, which tells me that the defenses are actually quite good. And I think part of the problem is that banks are, I'm not going to say used to cyber terrorism, but probably used to cyber threats because they manage money and they've probably been in the potential targets for criminal activity pretty much forever. So I think they've developed. Of course, we can't exclude that at some point you get a much bigger event than we've had so far. But the evidence for now is that the sector, is not really the credit risk of the sector, at least, is not really driven by that. That said, I cannot measure it. I mean, I've pretty much the same tools that everyone else. So it's more like a soft judgment at this point than anything else.
Yeah, no, absolutely makes sense. You touched on consolidation, Marco, in your comments. I think you were quite clear on your perspective, but perhaps you could reiterate your thoughts around the cross-border bank M&A in Europe, given that most of the transactions that were on that chart that you showed were, other than BPC and Portugal, were in country.
Yeah, sure. I mean, that has been our view for a long time. We do think that there is room for consolidation in Europe. We do see the value in domestic consolidation deals, specifically in markets which are still quite fragmented, because I'm thinking, Italy or Spain, good examples, because it essentially improves pricing power, you realize cost synergies. So all the usual drivers of M&A. But we've also highlighted for a long time that cross-border doesn't produce any of that. You're not taking out a competitor. You're not, you don't have, a branch overlap, or you don't have any obvious overlap in central functions. So the economics of cross-border deals are more difficult and should be predicated at least on funding advantages, whereby you can, more freely move excess savings from one country to another, excess capital from one country to another. But that's not really fully happening yet, and that's partly because we still have, despite the single rule book and despite the single supervisory mechanism, we do have a degree of fragmentation within the European Banking Union, for example, when it comes to deposit protection, which makes it more difficult, essentially, to realize these mergers in a cross-border sense.
Yeah. Okay, I've got a quick question, if I may. I'm not sure this is one for Alessandro, but let me ask it anyway, and you guys decide. What's the outlook for liquidity in the sector? For example, LCR, duration mismatches, and interbank lending. Do you want to make a general comment about liquidity?
Sure. I think it's an interesting question, because we are coming from a period of normalization of extremely high levels of excess liquidity in the market. In the post-COVID world, we've seen the LCRs reaching, I can't remember what was the peak. I don't know if we have a chart in the presentation, but I think it was in excess of 300%. It has come down quite significantly as the banks essentially repaid TLTRO lines. And since then, it has stabilized. So I do think it's becoming a bit tighter. We do know that in the United States, excess liquidity has dried up in 2025, and we had actually a few instances where banks had to hit Federal Reserve's lines, and I think that's also what's behind recent policy decisions by the Federal Reserve. I don't think in Europe we're there yet, so I think for the time being, the outlook is still of a reduction in sector-wide liquidity, which might put pressure on some business model which structurally run with tighter LCRs.
Okay, thanks. There's a question about France there. We could perhaps defer to your lead French bank analyst, Marco, but I guess, look, in the context, you mentioned that this convergence of sovereign spreads, and you've made the point that France, it's not that France has widened this, it's a periphery of tightened. But nonetheless, there is a sort of latent political, actual political risk in France. So let me ask a question, and you can, I guess, we can either delegate it to one of the analysts, or we can answer it now. But so, are political uncertainties weighing on the performance of French banks? Do you still expect French banks' net interest margins to recover, as loan production could suffer from the difficult macroeconomic environment?
Oh, it's a good question. We will come up with a specific outlook for French banks in the coming weeks. The view that we have taken, and just by way of background, where French banks are in the cycle is they're a little bit behind compared to the rest of the continent because of the inertia in the repricing of assets and liabilities, which is driven by specific legislation in France on usury law, mortgages, and regulated savings. So whereby we expect a normalization in net interest margins in most of other European countries. For France, this process is delayed. So the base case is that you still have some support from net interest margins. Now, of course, with the political dynamic that we're seeing, you need to offset that against potentially higher cost of especially wholesale liability, potentially hitting funding costs, and also on the asset side. So stepping away, just from the margin discussion for a second, on the volumes, whether this increased uncertainty will cause a slowdown in investment, for example, and therefore in bank loan volumes. I think it's a bit early to say. We haven't seen a lot of evidence of that. But I think the best, Keith, I didn't see who asked the questions, but I'm going to check it later on. And what we'll do, we'll send the French bank's outlook as soon as it's published. We might have, latest data points, which I don't have in top of my mind.
All right, no, that makes sense. By the same token, there's a question which we may need to go back to our questioner, which it's about the M&A topic. And is what way is the European Deposit Insurance Scheme an obstacle for M&A? Now, our question is looking for specifics and etc. So, do you have any top line thoughts, and we can circle back with some more specifics later?
No, sure. I mean, my understanding is that when you, I mean, it's a little bit technical, but you contribute to your national deposit guarantee schemes, right? And you have a legal entity which is contributing to a deposit guarantee scheme. The moment you want to operationalize a merger between two different entities in two different countries, there is no obvious way with which the contributions to one national deposit guarantee scheme get transferred to a foreign guarantee scheme. So what actually happens is that you lose the contributions you've done in one of the countries, and you need to rebuild your deposit contributions in the other countries. That's a lot of money. So no bank management can opt in into such a deal. This is why you see a lot of cross-border. You see not a lot, but some cross-border acquisitions. It is very rare that you actually see a merger happening. So if you look at a group like UniCredit or BNP Paribas is a subsidiary in Italy for the past 25 years. They don't merge it. UniCredit as a subsidiary in Austria or Germany for the past 25 years. They don't merge, which means you don't get to save money on all duplicate functions, board of directors, and things like that. So that was what I was referring to.
Yeah. Okay. There are lots of questions there, which I think we probably need to circle back. There's one of our questions has been quite prolific. So to that question, there are some questions that we perhaps, I guess some are observations rather than questions, but we will circle back. I'm just thinking now we've gone over, we're about at our hour. But I did want to ask Alessandro a question, just to make him, feel part of this this conversation. You've been sitting there very patiently, Alessandro.
Wait, then, because he can't hear you. So.
Okay.
Yes.
Hi, Alessandro. Just wanted to bring you in before we close. You've been sitting there very patiently. So, look, I guess is a question. You talked about net interest margins and your expectations that they're going to be tailing off, but by the same token, you expect earnings to be supported by, I guess, a number of factors. And one that you singled out was loan growth, among others. You mentioned fee and commission as well. I just wanted just perhaps to put that in the context of what Marco was talking towards the end, with this very tepid growth in a lot of core European economies. Not all, but I mean, so the scope forecast of 1% France, Germany, UK, 0. Well, it's not in the EU for sure, but 0.7 for Italy. So the question really is, how important is loan growth to your expectations for maintaining profitability? And how confident are you in the context of poor growth and other factors, trade, geopolitics? How confident are you that loan growth is going to continue? And will that be corporate, consumer, both? So 5 questions in there, but perhaps you can talk about
very lengthy one. So I'll try to give a short answer to a long question. Loan growth is a key pillar of for bank profitability in Europe. In our forecasts, we expect the loan growth to be strong where economic growth is also strong, whereas we see some weakness where actually growth is quite weak. So in Italy, now in France, Germany, but overall we see a widespread recovery in economic growth. In the retail market, you have the strength of the residential property market, which is a key factor, and this is particularly true in Spain and in Netherlands. Then you have sector-specific investments, public financed investments supporting growth in Euro periphery, in Greece particularly, which is driving up credit demand. There's been a recently published EBA assessment that shows that most of banks expect credit growth, particularly in the SME area and in residential mortgages. So just few banks expected a lower demand from, or rather lower exposure to commercial real estate, but in the whole of all the other segments there is upside potential. So our central scenario is relies particularly on loan growth. There remains, yes, downside risks coming from trade, the trade tensions, geopolitics, but yeah, they are here to stay, but our central scenario is that loan growth will be quite strong in 2026 and 2027.
Perfect. All right, thanks. And Alessandro, could you pass back to Marco for one final question?
One final question, Marco.
Okay, Marco, I was going to clear. We got one question. I know this is a topic that you thought about, and the question is, I believe this should be the last question. Do you still see risk related to the bank sovereign nexus? If yes, how important is it, and what factors could mitigate or reduce it?
Yes, of course, there is still risk related to the bank sovereign nexus. Unfortunately, this is a very difficult one to break. But it's a topic very close to our heart at Scope. We try to be a positive force in breaking up this nexus. For example, in our ratings, we don't have a direct correlation between bank and sovereign risk. We don't have hard sovereign caps. A lot of things have changed over the last 10 years, right? So we now have resolution regime which ensures that if you have a bank failing, you don't have a contagion to the sovereign side. We have a stronger sovereign with a fiscal compact. We do have less interconnection between banks themselves. But it is true that, in the end, there are a number of factors which still translate in a degree of correlation. So it's not something that can be completely ignored. One example, again, is the deposit protection. You still don't have the same degree of depositor protection in the different countries in Europe. So there is and actually, interestingly enough, people assume that deposits are guaranteed by public sector. They're not. They're guaranteed by deposit guarantee schemes, which are private sector entities. But there is, a sort of underlying market assumption that if the funds of the national deposit guarantee scheme will not be sufficient, at some point the governments will step in, and therefore, being in a AAA country is not the same as being in a BBB country. And this, again, if you go back to the importance of completing the banking union, something that should still be, I think, on the political agenda.
Yeah, absolutely. Okay. We could go on for a lot longer, but I think in the interest of everyone's patience, we need to draw the session to a close. And look at the numbers, we still have a good number of people on the line, guys. So thank you so much to everyone for taking the trouble to register, dial in. Thanks for some amazing questions. There are some that we will circle back to our questioners on that we couldn't answer today. I did say at the beginning that I was going to give you the opportunity to download the yet to be published Banking Outlook 2026, which I mentioned has some country snapshots over and above what's in the slide deck here. So hopefully, like Anne, you can see the opportunity there to download now. So please do that. If you have any further questions, please feel free to get in touch with any of us, and we will do our best to be responsive. And I always say at the end of these sessions, there's so much to discuss. Some of these topics, I think, were sessions in their own right. I hope we gave you at least some reasonable high-level responses. Clearly, these are changing literally by the day. So to the extent that things change that we feel demands another session, probably not in December, but certainly in the new year, we will certainly be up for another session. So look out for updates on that basis. So just remains for me to thank Marco and Alessandro for some fantastic comments amid some less than optimal technical conditions, but hopefully next time the technical gods will be shining on us. So thank you very much indeed. I wish you a very pleasant rest of the afternoon, and we'll see you next time. So it's bye from us.
Thank you on behalf of Alessandro and myself as well, and probably happy festive season if we don't speak before. Bye.
Bye.